If you're not well positioned for an economic recession at all times, you could be risking everything. When a financial crisis occurs, it's no rare event for individuals to lose their jobs that had the illusion of stability. Their retirement savings could be sliced in half, and they could even lose their home to the bank. All of these could cause lasting health implications and troubled relationships. It's easy to forget about the times of misfortune when the economy has been performing well for an extended period of time, but there's never a point in time when the effects of slowdowns should be minimized. Luckily, when an economic downturn occurs, this provides massive opportunity for those who have a high level of financial stability. A recession can provide them the opportunity to even build incredible wealth beyond what they could have imagined. In today's video, we will look into how to prepare for the recession in 2022 and possibly take advantage of opportunities as they present themselves. But first, let's discuss what recession means. What is a recession? A recession means a significant decline in general economic activity. However, the National Bureau of Economic Research (NBER) currently defines a recession as a significant decline in economic activity lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Manage financial stress. These days, it's easy to experience anxiety and stress around the future of the economy. The latest bout of inflation is causing high price tags on essential consumer goods to skyrocket. News headlines are filled with recession speculation, bear market fears, and interest rate hikes. Things are costing more, says Amy Hubble, principal investment advisor at Radix Financial. People are starting to feel it more. They're spending more at the grocery store and more at the gas pump. That puts anxiety in people's heads. But business cycles consisting of periods of growth and contraction are normal and have been observed time and time again throughout the country's history. The US has entered a formal recession 14 times since the Great Depression. Recessions have lasted an average of 17.5 months historically, with the most recent recession occurring in February of 2020 and lasting only 2 months. To manage your financial stress, educate yourself about business cycles and make a plan to weather this and future downturns that are an inevitable part of any economy. In the end, Hubble says the long-term effect of a recession on most consumers is minimal. Change the way you spend. With a recession looming, it's time to review your budget. Start by reviewing how your expenses have changed over the last year to determine where cuts should be made. A recession is something your financial planner should have already accounted for, says David Ray, president of DRM Wealth Management. You might make small adjustments, like if your rent goes up 30%, but those are adjustments rather than drastic changes. During the Great Recession, that ended in 2009, consumer spending experienced its most severe decline since World War II. But exactly how individuals will be affected by a recession and rising prices varies. The Great Recession was particularly painful on the young, poor and middle class, Chintagunta, and Biswas wrote in an email. But not all consumer groups responded equally in terms of changes to their consumption behavior. For example, they note, food at home expenditures went up disproportionately more for older, more educated, white and Asian households. And younger households switched more to warehouse clubs, whereas older households switched more to discount stores. Review your asset allocation. Investing during a recession can be scary, but experts suggest that sticking to your investing plan during an economic downturn is critical to its success, and retreating to typical safe haven assets like bonds comes with risks. There's a cost to safety, Ray says. You don't lose money when the market goes down, but you don't make money when the market goes up. Investors have a tendency to panic when their portfolios take a significant loss. But imagine selling all of your equity assets during the early days of the coronavirus pandemic just 2 years ago and missing out on the subsequent market rise that followed. The latest market slump can be viewed as an opportunity, Hubble says. If I had any cash left, it would be in the market, she says. Diversify your investments. If you don't have all of your money in one place, your paper losses should be mitigated, making it less difficult emotionally to ride out the dips in the market. If you own a home and have a savings account, you already have a start. You have some money in real estate and some money in cash. In particular, try to build a portfolio of investment pairs that aren't strongly correlated, meaning that when one is up, the other is down, and vice versa, like stocks and bonds. This also means that you should consider asset classes and stocks in businesses. that are unrelated to your primary occupation or income stream. Be real about risk tolerance. Yes, investing gurus say that people in certain age brackets should have their portfolios allocated a certain way. But if you can't sleep at night when your investments are down 15% for the year and the year isn't even over, then you may need to change your asset allocation. Investments are supposed to provide you with a sense of financial security, not a sense of panic. But wait, don't sell anything while the market is down, or you'll set those paper losses in stone. When market conditions improve is the time to trade in some of your stocks for bonds, or trade in some of your risky small cap stocks for less volatile blue chip stocks. If you have extra cash available and want to adjust your asset allocation while the market is down, you may even be able to profit from infusing money into temporarily low-priced stocks with long-term value. Buy low so that you can sell stocks high later or hold on to them for the long run. Be careful not to overestimate your risk tolerance, as that will cause you to make poor investment decisions. Even if you're at an age where you're supposed to have 80% in stocks and 20% in bonds, you'll never see the returns that investment advisors intend if you sell when the market is down. These asset allocation suggestions are meant for people who can hang on for the ride. Reduce variable rate debts. Though minor changes may be made to your investing strategy, major ones may be made to your plans to borrow debt or pay off existing variable rate loans. Whether you are in an expansion period or a recession period, you really don't want to change your activity towards saving and investing, Hubble says. You may, however, want to change your posture towards spending and taking on debt. As the Federal Reserve seeks to tame high inflation, it plans to continue raising interest rates. Higher interest rates make it more costly for individuals to borrow money and make variable rate loans, like credit card debt, to become more expensive. Take another look at your existing debts and consider paying off those with variable interest rates. If you're seeking to become a homeowner or take on any other major debts, consider delaying these purchases or adjusting your budget to accommodate the greater expense associated with borrowing today. Plan for a possible job loss. During recessions, the unemployment rate typically rises. Take a moment to consider your own personal risk and plan accordingly. How likely are you to be one of those people losing your jobs? If you're a realtor or mortgage broker, for example, things could be tough going forward, Ray says. Work to make yourself more valuable to your employer while dusting off your resume and keeping an eye on other job opportunities. In the worst case scenario in which you do experience a layoff, having already built up an emergency fund of, at minimum, 3 to 6 months of expenses saved in cash is key. In a recessionary situation, the biggest risk is that you could lose your income, Hubble says. So you want to have cash on hand to make sure you can weather a loss of income. Even if you have a great full-time job, it's not a bad idea to have a source of extra income on the side, whether it's some consulting work or selling collectibles on eBay. With job security so non-existent these days, more jobs mean more job security. Diversifying your streams of income is at least as important as diversifying your investments. Once a recession hits, if you lose one stream of income, at least you still have the other one. You may not be making as much money as you were before, but every little bit helps. You may even come out the other end of the recession with a growing new business as the economy turns up. So guys, that's all for today's video. What's your opinion about this? Please tell us in the comments section below this video. If you haven't subscribed to our channel yet, please do so to support us. We will be back with another video.